Gershon Distenfeld, in your view, actively managed high-yield funds are far outperforming high-yield ETFs. It's not even a contest in your view, right?
Absolutely. I mean, the numbers tell the whole story. You don't have to really give fancy arguments. These things have been around for almost a decade, and they've well underperformed the average active manager.
All right, so what about the idea that high-yield ETFs like the HYG or the JNK are better for investors because they're cheaper and they're more liquid than actively managed funds?
Well, I don't know what cheaper means. I mean, the management fees are slightly lower. They're not the few basis points you find in the equity world. They're 40 and 50 basis point fees. But again, let's look at the numbers. The numbers tell the whole story. In over 8 years, they've underperformed a high yield index by about 200 basis points, and some of the top tier managers by 300 or 400 basis points.
All right, one of the big debates right now is that high yield ETFs are dangerous. You hear that from Carl Icahn. He was debating Larry Fink not too long ago. Where do you come in on this particular subject?
Well, it's funny that I followed that very closely. Carl Icahn, I think, just likes to rank on high yield. He doesn't care what necessarily the vehicle is. But I think both of them miss the point. There are definitely benefits. They can add liquidity to the market. They can be used to hedge portfolios. There's some good uses of ETFs. But as a strategic investment in high yield, again, the numbers tell the whole story. They just haven't performed well for investors.
All right, so let's talk about high yield bonds themselves. Are they reasonably valued right now? Is now a good time to get in?
I think as long as you're careful and you don't really stretch for the yieldiest stuff, valuations are more reasonable than they've been in quite some time. We are getting later in the credit cycle. You're going to have to be more selective. But we think that high yield can produce very good returns, especially relative to the rest of fixed income.
What about the idea that we're going to get another energy sell-off very soon because the banks aren't going to be lending money to the energy companies coming into the fall? We saw the energy sell-off really hurt high yield back in the winter of 2014. Is it going to hit again this winter?
It might. Our view is that if we're in this new range of oil, call it $40, $50, that we're going to see a lot of defaults in the next 2 or 3 years in the energy sector. These capital structures were built assuming we're going to have $100 plus oil. What I think people miss is that for the rest of the high yield market, energy might be the biggest sector, but there's still another 80, 85% of the market. It's mostly good for companies. And in fact, we think defaults outside of energy are going to end up being lower than they otherwise would have because oil has fallen so much.
All right. Are there any sectors that you like in particular? Any companies? What are you watching if you're trying to get rid of your energy exposure?
Just to make sure that you answer the most important question that you always have in high yield. Am I going to get my money back? Manage diversified portfolios, stay away from the problem areas. We see energy still as a potential problem area. We see triple Cs broadly as we get later in the credit cycle. They might fool you into thinking they're attractive because they have high yields, but we think they're going to have severe default rates, and even bank loans is something we're very cautious on.
And since this is a big Fed week and nothing happened, how will a Fed rate hike, whether it be in October or December, affect high yield?
Well, I'll be forced to be talking about it for the next 3 months until it actually happens, or perhaps even longer. At the end of the day, the high yield market, or at least the default rate in the high yield market, isn't going to be much impacted whether the Fed funds rate is 0, a quarter, or even 1 or 2%. It doesn't impact the real economy as much as you'd think, and certainly doesn't impact the default rate, which is the most important return metric for high yield.
All right, well, thanks a lot, Gershon.
Thanks, Greg.
And thank you for watching The Street.